but I'll provide you information because I love to do this. People often ask me, well, David, why do you do this? If you're in such good shape financially, and it's like, look, I just love what I do. I learned some things in life, and if I can provide that to other people and be a support and a guide to them, then more power to what I can give you. I also have a YouTube channel, a podcast. I do a blog series every week, and I think we're on book number 7 or 8, one of which I'm going to provide for you at least an opportunity to get if you want to tonight. Again, use the chat, and I'll also answer some questions at the end of the session tonight if there's some time, or if you want to stay on for a little bit longer. All right, let's jump in. Let me get my screen share up here, and we'll get started. Okay, we did title this the Election Survival Guide. So for those of you from the Republic of wherever the Republic is you're coming from, this might be good for you. 32 days until the election. Again, I'm not going to take a bent either way on politics. What I am going to show you tonight is some of the things that we have to deal with in our own world. What we can control is going to be irrespective of who wins the presidential race coming up in 32 days. Let's dig into it. Current headwinds. Again, I'm going to go quickly tonight. I will read some things to you, some things I'm going to breeze through. So high-level concepts. But we've had 40 years, going back to 1980, of decreasing cost of capital. Interest rates started at a high of 20% federal funds rate in 1980 with Paul Volcker, and has gone down ever since to a low of zero, next to zero in 2020. Those were the tailwinds that many of us, I certainly include myself in that group, that were able to take advantage of that. It wasn't just my genius or other people's genius, but we had really significant tailwinds to help us to gain momentum in business and in investments, whatever we invested. There certainly were market cycles in between, the last one being the GFC, Great Financial Crisis of 2008. We had that blip in COVID in February, March of 2020. But we find that the Federal Reserve seems to always come to the rescue, and we'll talk about that tonight, what's called the Fed put, saving the financial markets from total destruction. We've had 30 years of globalization where we have had the outsourcing of labor and goods that we import. That COVID disrupted a lot of that, and the deglobalization is happening now. So that's where inflation's come from. A lot of the inflation has come from that. There's also been fiscal and monetary irresponsible policies and spending by our government, which has added to it. So the fuel to the fire of seeing inflation for the first time, 18, 20 months ago, for the first time in 40 years. And now the Fed thinks, well, we've whipped it. I say not so fast. I don't think they've whipped anything. I think it's still a seesaw battle. We've had 14 years of this debt-based economy. And when we say debt-based, there's no real economy that can be based on debt. Our own lives, our businesses, we can't base it on debt. If we try to serve ourselves on debt, we're playing a game. This country gets away with it because we've had the reserve currency since 1944. That's suspect today as we see the BRICS countries and others pulling away from the petrodollar and looking to go back to gold-backed currencies and remove themselves from the rule of law that the U.S. has mandated, and really a lot of countries want out of that. So our opportunity to keep kicking the can down the road is becoming less and less a feasible point in the future. Again, that's why we have to be concerned. The COVID factor, that opened the gates to all the spending, the profligate spending that occurred, and there seems to be no turning back at all, none whatsoever. The geopolitical volatility. Obviously, we have things ramping up quite a bit in the Middle East right now, just this very week. Russia, Ukraine, China, Taiwan is simmering. And these hot spots that we haven't seen for a number of years have been rising quite a bit in the last, 2 years. As I mentioned, the fiscal deficit spending nearing $2 trillion per year, unbelievable. Unfunded liabilities just tack on, another $150 to $2 trillion that it's off balance sheet, but it's there, right? It's been promised. The leverage that we've been using, the arbitrage, the derivatives in the financial markets that people think will never end, that can cause a major downturn when whatever turns the markets causes that to happen. Taxes. I mean, nobody wants to pay more taxes. We're probably at the low point of taxation right now. It's only going to go up. And again, that's just something we have to bear in mind. Inflation, we talked about interest rates, where they are. We'll talk about what's happening with interest rates in a minute. The cultural shift that we've seen really in the last decade and a half, and then COVID just seemed to like extend that. You know what I'm talking about, the what was called the Great Resignation. Nobody wants to work anymore. You know, it's if you're a business owner, you know exactly what I'm talking about. It's really tough out there today. And then of course the election. The accumulation model that's been a traditional model for years and years. It's the Wall Street model. It's what everybody is, you know, kind of abdicates to because that's what everybody does. Just a quick look at this. If you've got $2 million, and let's just say you're being very conservative and looking at a 4% return, which you can get in treasuries today, but you need to take 10,000 out per month to live off of, that's your depletion part, then you're going to run out, you know, over a period of 25 years. Now, some people might say, well, that's good enough. If I could have $10,000 per month, take it out 25 years. But again, going back to the inflation factor, we have to deal with that. What happens if we have 4% inflation? Well, instead of going out 25 years, we reduce that down to 17 years. Just with a 4% inflation, now I think all of you would agree that inflation is running much higher than what the government tells us with a CPI. They manipulate those numbers. I would bet inflation is still running close to double digits. I mean, just look at your own report card on what you spend on in property taxes, insurance, utilities, food, everything is much higher. They've even said like the cost of healthcare or healthcare premiums has gone down. Who's that gone down for? I mean, it's so manipulated. So you have to factor in what do you really think inflation is? And so let's just take another stab at it. What if it's at 8%? Well, now we reduced that 25-year span of depletion all the way down to 12 years. Cut it in half, more than cut it in half. So inflation's got to be something we have to be concerned with. We didn't have to until in the last 4 years. It's become a major factor. And all the financial models that people have used and financial advisors who've been doing their work for the last 80 years have not had to deal with this. Most of the financial advisors out there today have not seen a full secular cycle, not a market cycle, but a secular cycle, which we'll talk about in just a minute. One more look at inflation. Let's just look at 12%. On $1 million, 12% inflation, we'll cut it in half in 6 years and cut it by 75% in just 12 years. Again, you figure out what you think the inflation run rate is, but I don't think it's anything close to what they're saying it is. You pick your number, but I think if you're doing things shy of 8%, I think you're probably fooling yourself, my opinion. The sovereign, the national debt, which we're adding on to at light speed, like nothing before, is over 35 trillion. And we just crossed 35 trillion. I mean, it was just a few weeks ago. It was just a few weeks ago. I think we just started the fiscal year for the government, just started October 1st. And like the first day, we were in deficit spending by if I remember the right number, $275 billion day one of the new fiscal year. This is not sustainable, and we all know it. I think we like to put our heads in the sand and just pretend it's not there, but the fact is it's there, and it's a real problem. Everybody says, well, it's worked before, and hey, look at the financial markets. They're still going strong. They're still going strong. Buy more, buy more. The FOMO is strong today, and it's hard to resist not just saying, well, you know what? It's continuing to work, so I'll just stay there. I think it's a big mistake, and I think you're here because you know it's a big mistake too. The national debt, just looking back at whether it's Democrat or Republican, the main thing is it's both sides. It is both sides that are ramping it up. There's no hawks on either side, and certainly between the two that are running for president, there's not going to be a decrease in spending. This is some various advisories that try to be non-political and look at the two camps. In blue is Kamala Harris and red is Donald Trump. I would just look at the left side where they're looking at spending. And you can see both of them are showing to keep spending a lot of money. They're showing Trump spending more, Kamala less. Again, my point is it's not going to matter from that respect. We are spending on steroids, and neither side appears to be in a position to take that on. And how can you if you're a politician? You got to get elected. You can't run on austerity, although that's what we should be. The consumer today, and that's what drives the GDP. That's what drives the stock market equities. What drives housing. It drives everything. And if the consumer is tapped out, everything is going to take a hit. And if you just look at what's happened to the savings rate, which is in green, there was a big savings pop when? Well, during COVID, no one could spend money and they were getting helicopter money, sent out, hand over fist. Can't spend it, stack it up, put it in the bank account and feel like you're rich. Go out and buy some cars and stuff like that you can't really afford, and it's all good, right? And now, but look what's happened to the debt now. It's surpassed over $1 trillion just in this last year. That's consumer debt. It's spiraled while the savings rate in the light green is all the way down. I heard it's down to like 2.9%. Here it shows 3.2. It's gone way down. Why? The consumer is tapped out. And this bodes very negatively for really all investments, and it bodes negatively for businesses, our own practices. If the consumer's tapped out, they're only going to be getting emergency care. The big cases, the elective stuff. I mean, most people are tapped out, not going to be able to do it. The tech stocks have been what's driving everything. And this is not the first rodeo of this. If you go back to 2000, the dot-com, same thing. Tech was driving it. People thought, there's no end to this. It'll go on forever. Nothing goes on forever. We don't know what's going to break the camel's back, but this is what's been driving the stock market. It's been tech all the way. If you look at the rest of the 493 stocks in the S&P 500, they've been very, very tepid. So again, this is an outlier situation here. I mean, if you've been in there and you grab it, you've taken it, you just got to know what to do with it now, right? Do you stay there or do you move your capital somewhere else? That's a decision you have to make. The market cycle in brief, I think most of you understand that market cycles, they're not as pretty as this. The one we've been in has been extended, so it's kind of like way up and kind of bumpy with COVID in 2000. But where are we today? I would say we are in denial. We're on the downslope. We're just in denial, right? What happens next? Something's going to trigger the fear. And when the financial markets hit fear, that starts to roll off really, really fast. And it's just like the sentiment, the psychology of the marketplace, which is a lot of retail investors. A lot of retail investors have their money there, and they're the first ones to tap out and run for the fences. And when that happens, it's just a spiral down. So just keep that in mind. It always happens. We just don't know exactly when. Rate cuts. Okay, the big news it's been a week now, or has it been 2 weeks? I lose track. But 50 basis points, the Fed came out, and the big question is, if the economy is so strong, so they say, if the jobs market is so strong, if things are rolling and we're predicting a soft landing, why the heck did you have to have 50 basis points cut? I say because they're in panic mode. They just aren't going to reveal it. So every time in the last number of decades, the Federal Reserve has started a rate cut after raising rates or having them high, every time that we've gone into a recession. And so again, if you look at this chart, right, all the gray verticals, that's recessions. You can see the last three with orange, going back to dot-com 2000, 2008 GFC, and then COVID, the drop in 2020. Every time the Fed does this drop, then right after that we start going to recession. So again, data is data. Does it happen this time? Maybe it doesn't, but it certainly looks like there's a good possibility. All right, so here's a question for you, and I think we can run a poll here. Alex, are you able to run that poll? My question to you is going to be: will the Fed's rate cut will have a positive or negative effect on your investments? There's the poll. So I just like to know, what do you think? I mean, some people might think it's going to be good because it's going to ratchet back up the market higher. So your answer is anonymous. I'd love to see, what do you think? So just pick one: positive, neutral, negative, or you're just not sure. If you just jump in there and pick one, I'd like to know kind of what your feelings are about the Federal Reserve's rate cut. And once you've had a chance to do that, then we'll take a look and see kind of what the sentiment is of the audience here tonight.
We'll give it just another moment here. If anybody else wants to weigh in. All right, very good. And 3, 2, 1. There we go. David, can you see those?
I sure can. Okay. Well, the preponderance, almost 50%, said probably negative. 25% or so said neutral. Some people saying positive, and some not sure. Yeah, look, I think whatever your take is on it, that's the right take. Depends on where you are, like in your career path, what your business looks like, where you're invested today. So there's no right or wrong answer. I'm just curious as to what you thought. So thanks for playing along. All right, so we've run through that. That was the answers. So again, the Federal Reserve saying, they think they're going to pull off the soft landing. that inflation has been more or less whipped, and it's all good. Going back to 2007, on the exact same date as actually September 18th, when they last dropped the federal funds rate by 50 basis points, it was September 18th, 2007, and the S&P fell after that in the next 372 days, next year, by 54%. Okay, will it happen again? We'll see. 10 of the last 14 federal rate cut cycles led directly to a recession. And remember, when people say, well, lowering interest rates should help everybody, this is only short-term rates. The Federal Reserve is not able to control at all the long-term rates, which would be home mortgages or auto loan rates, other consumer rates. They don't control those at all. So just bear that in mind. People think, well, the home interest rates are going to come down. Well, they may, but I say the overall bond market, the bond investors, which is much bigger than the stock market, they're the ones that control what interest rates do, because bond investors are very wary of inflation. And if they sense inflation's on the rise, they are not going to put up with low interest rates. I mean, that's how they make their money. And so they're not going to put up with it. They control. Federal Reserve Jerome Powell does not control that. The decades ahead, a new secular cycle. So what's a secular cycle? That's a longer than a market cycle. Market cycles typically 6 to 8 to 10 years. The last one that we've been in got stretched a lot because of COVID. But a secular cycle is what I talked about earlier, going back several decades. And in this case, you could go back really 4 decades to 1980, all the way down to 2020. That's a secular cycle. The secular cycle ahead, I believe, and the people I study believe that it's going to be a slower, more anemic growth. We're not going to have this big ramped up growth like we've had, over the last decade, 12 years or so. Demographics are changing rapidly. I'm in that boomer sector where boomers are retiring by 10,000 every day and aging out. That's going to change a lot of the dynamics in consumption and also in housing. The higher for longer interest rates, where are they going to be, right? Again, Federal Reserve can play games all the day long on the short end of the curve, but on the long end, that's going to be the market. The market will determine that. And then I think we're going to have persistent inflation. Look, the government can't deal with a massive debt that's continuing on and on as it is, adding $2 trillion a year without monetizing or the debt. That is decreasing the purchasing power of the dollar. That's what inflation is. So inflation, I believe, is here to stay and probably only going to get worse. Stagflation was the term that was used for the 1970s, really from 1965 to about 1980, 182, 15, 16, 17 years, where the overall economy, including the stock market, did nothing. It was flat. I think we've got a graph on that. It was flat. So again, recency bias says, well, all I have to do is put my money in certain sectors of the market and it's go, go, go. Or this interest rate cut's going to continue to blow it up. You may think that, but I think we've got to take some chips off the table. At least you've got to diversify and move some things to different sectors to at least hedge against what may happen. If you haven't read a really good book on what's happening with these secular cycles, is a book by Neil Howe. He actually wrote one with his co-author, William Strauss, back in the late 90s. Just called The Fourth Turning. This is the update from Neil. The Fourth Turning is here. I think that came out a year and a half ago. Very, very good book. And then on the right is Howard Marks. Howard Marks, great writer, and he wrote a dictate about 18, 20 months ago called The Sea Change. Again, talking about these long-term cycles and how we're in a new long-term cycle of, instead of low interest rates, rising interest rates. Now, I don't think we're going to get back to 20%. There's no way that was going to happen. But it's not the total rise in rates. It's the rate of change that makes a big difference. And the rate of change, we saw in the last 3 years was massively going up. Is it going to go down that hard? Again, I think the Federal Reserve's, fighting this inflation thing, which they have no place to land is the problem. So here's the 40-year cycle I referred to. If you look at the peak there of interest rates, that really is peaked about 1980. And then we had the drop over the years, and you can see the recessions in the gray verticals along the way. You can see in 2020, rates starting going back up again. So again, the end of a long-term secular cycle, the beginning of a new cycle, which means all of the old models that anybody you believe in, financial advisors and wealth advisors and 401k managers, I think you have to throw all that out the window. Like, so who has the new blueprint? Well, I don't think anybody does, but I think this is a time when understanding the markets and understanding the different places you can put your investment capital is important to learn and understand. Here's that graph of stagflation. If you look at that red horizontal line, that's from about 1965 all the way, as I said, to about 1980. So 15, 16 years of just what they call the lost decade. A lot of people, including Jamie Dimon of Chase Bank, is saying it looks like we're having stagflation. Again, there's lots of different economists that predict different things. I'm not a doomsdayer, but I think we have to hedge against this and not think what we've seen in the past is going to come back and be what we call the normal again. So how do you de-risk your portfolio? Well, I think there's a place for precious metals as insurance, personally. And again, I'm not giving you financial advice. Please understand, this is just my own experience. So I'm just giving you my experience, what I see, but it's not financial advice, tax or legal at all. Treasuries and income-producing cash equivalents. So cash equivalents would be where I can turn the investment into ready available cash quickly, relatively quickly. I say 30 days or less. If I can do that, then that's a cash equivalent. So I need some of that. I need some margin because I want to make sure I can get through the gap of whatever we have in terms of recession, but I also want to have capital ready to go and buy the opportunities that are coming. So some allocation there. And of course, as I've talked about already, we've got to have an inflation hedge somewhere. So maybe not as heavy right now where we're going through some disinflation in assets, and I think that's still to come, but being ready to move back into the proper, whatever's proper for you, inflation hedge assets. I like hard assets. We'll talk about that. I just think hard assets is the place to go, but it's more difficult to invest in hard assets outside of your own business, which is a hard asset. This is a pyramid or a triangle that I created, again, that kind of shows the same thing from the previous slide. If you look at the bottom, I've got liquidity, safety margin. This would be like your moat, your safety around the castle, your insurance. And I talked about what that would be, cash equivalents, probably some precious metals. On the right side would be, that's your lifeline. That's your actual income, dividends, rents, interest, cash flow. That's the oxygen that feeds you from your investment. So you need some of that, particularly when you're moving from active income, trading time for dollars, to less of that, or maybe retiring altogether. Now you've got to focus there a lot. But at the same time, we've got to have some growth and some inflation hedge on the left side of the triangle, because if we don't do that, we looked at earlier how quickly the purchasing power of our nest egg, our accumulation, is going to be cut by the different rates of inflation. So we've got to have an overall strategy here that we can rely on. And again, only question to you, I'm not going to give you all the answers because it's just my bias, but where do you put your money in these allocations? Something that you have to work out, something we talk a lot about at Freedom Founders, but I am not the financial guru. I just tell people what I do and what's worked for me over a number of cycles over the years. Billionaires are buying what? Hard assets, farmland. So we've got Bill Gates, we've got Jeff Bezos, we've got Ted Turner, we've got John Malone. Buying farmland. Now, if you've got all the money in the world, buying assets like farmland or even precious metals, they don't produce any cash flow, right? But they are a good inflation hedge. So I'm not saying farmland is the place I can go because I don't have all the money in the world. But what we're seeing is the smart people are putting a lot of their assets, their capital, into the hard assets, the tangible assets. I think that's a clue. Again, I like real estate or businesses because while it's also a hard asset that will be typically hedged to inflation, they also produce cash flow of some level. So that's why I like what we do in real estate. But these gentlemen, they don't need the income because they got plenty of income elsewhere, so they can just go into the hard assets and put their money there, which I think is a very safe bet. Real quickly, my background, I'm going to go very quickly on this. I did practice dentistry, my own practice, for a little over 20 years. Real estate, which I started building up while I was still in dental school and started adding to my portfolio, was what really gave me the optionality to leave my practice in my 40s when my daughter was facing battles with leukemia, epilepsy, and then she finally had to have a liver transplant. And I had to escape the chair to be with her. I could have gone back. I just never did go back. That's another story because I actually found something I love very much in helping my colleagues, and something I used in my own life to get free. That's why I do what I do today. I've had the opportunity and the privilege to help literally hundreds of couples, professionals, build their plan and help them with their allocations. Again, not being a financial advisor, but doing it with them. And they still want to have their financial advisors, but just showing them how they can get their money into the hard assets that maybe they haven't had the opportunity to do so to date. What this gives us at different places in our lifetime is the discernment and certainty that we are building towards a milestone that gives us what we really want in life, and that's more time. And the question is, when am I there? We'll talk about, when can I say I'm there, or I have enough, or I can slow down? Because most financial advisors just tell people, well, you should just keep going as long as you physically can, because we don't know. Well, it's because the accumulation game doesn't provide for determinate cash flow. And we'll talk a little bit about, accumulation net worth versus cash flow. Lifestyle liabilities. I think we all know that it's easy to let lifestyle escalate as our income goes up. It feels good, feels like we should be able to do so. And I'm not saying people shouldn't do that, but when people let their lifestyle, elevate at beyond their ability to earn the income or have assets produce the income, of course, that's where the problem happens. And the creep happens gradually. And I talked to so many docs who, are in their late 50s and early 60s or mid 60s, and they've done well to provide for their family over the years, but they never had anything that stuck, meaning where are the assets? Got a little bit in the retirement plan. Hopefully I can sell my practice for, XYZ, but man, with all the millions of dollars that came through their hands figuratively in their business, very little stuck. And I think that's a big problem today. The margin you want to have is what lets you actually live your life and not feel guilty that you're not working like 4 days a week and missing all the opportunities with your family. And that's where I see so many people giving up too much because they're not sure and they haven't had the proper financial education to know how to make their money work for them as well as they know how to make the money. Two different things. We get good at making the money because of our skill set and our education, but we abdicate typically to somebody else to say, well, you take care of the money part. I think it's a big mistake, a big mistake. So here's just a question that you answer to yourself. How do you feel that you index, meaning I'll give you a scale of 1 to 10 at home with your family and your close relationships? Number one, do you feel like you're under indexing at home? It is hard to balance everything. So do you feel like, on a scale of 1 to 10, where are you? Are you below 5 or are you above? If you're above 5 or moving towards 10, then you're doing a good job and you should feel good about that. However you manage to do that, not feel guilty that you're giving up too much on the net worth and the income side, but you're spending time with your family, good for you. Most people, hardworking professionals, highly educated, find that they're indexing on the lower end of the scale. And again, I think that's a problem. How do we overcome that and not live life with regrets? For me, this is the first house that I bought with the help of my dad back in 1980. Yeah, how many years ago? That's almost 45 years ago. 1980. And that's what I learned would produce income because I waited tables in the evenings during dental school, actually college and dental school. But during dental school, I was managing this house. I didn't live in the house. I managed it. I lived in a little apartment. I managed this house, 2 tenants over 4 years, split the proceeds of anything with my dad after he got his money out first, of course. We split after that about a little over $50,000 in capital gain profit. I got my 25 and I went on to parlay it into more properties over the years. That's what built my model going forward. I did as a young person. I got started before I was married. And then during the years I was married for 9 years before we had our first child, it gave me a lot of opportunity to do a lot of do it yourself. And I learned a lot. And if I had a family, like a lot of people do early on, probably couldn't have done it. So I'm just letting you know that what I teach today is not do it yourself because most of the people that I work with don't want to do what I did when I was in my 20s. And I don't blame you. You shouldn't. There's a better way to do it, a faster way to do it. But when you don't have any money and you have more time, like I was in my 20s, then that's the way you go about it. And any young person, I'd say that's exactly how you do it. You're the hustler. You go out and find the stuff, you manage it, and someone else that has the money will put the money in with you. It's really what we teach today in Freedom Founders because we have the assets. We want to get those deployed into diversified assets like real estate. That's how we do it. So what's freedom? You have options, you have choices, you have flexibility. You can live without want or need. That's a wonderful place to get to. And I can say that really what gave me that freedom was when my daughter was surviving her liver transplant, and I made the decision to sell the practice because I had enough, not all the money in the world, and certainly not enough to, if I did nothing at all, to last through the end of my life. But I had enough to give me the time I wanted to spend with her. And that is living life without want or need, when you can actually focus on what's most important to you and not feel guilty that you're not working and making the money like we're all taught that we should be doing. So real quickly, the five freedoms is a pyramid that I created that I use in Freedom Founders a lot, where the base of it is economic or financial freedom. That's what we all shoot for, right? But what we really want is the next level up. We want time. We want freedom of time, but we know we can't get that unless we've got financial freedom, other assets producing the lifestyle burn rate that we right now work for, right? Relationships. Well, that's really, really important, but it really becomes more important as we get later in life. We start realizing we've been missing a lot of the opportunities to spend time with the people we care about. We've been putting up with a lot of people we shouldn't have to because why? We have want and we have need. Remove that and you start focusing on the right people, making the right memories. Health. How many people put off health because you're in the grind? And you just say, well, I'll get to that. I'll get to my health when I get through all the tough times in life. And I'm saying, that'll never happen, right? There's always going to be something that will stop you. So again, when you can get to a point where you can measure your assets that are building for you in the cash flow that these assets can produce for you, even before you're free economically, you can take a breath and actually focus on these other areas of life, which you don't want to leave to the end. Because you leave to the end, it's too late. What have you done all the work for, right? If you don't have your health, if you don't have the people you want to spend time with, if you never had the time to do the things you wanted to do, what was it all worth? Top of the scale, something I didn't really roll into until I was really free of my practice, and that's really what's my real purpose in life. Yeah, I was a dentist and served people well for a little over 20 years. I think my purpose today is really to take the lessons I've learned in many of the tough way and give them back to the people that want guidance support in at least what I know how to do. And I'm not the expert in everything by any means, but I do know how to shepherd people and help them gain clarity about where they want to go. And clarity is probably the main thing that people don't have in life, is there's just really not a plan that they have developed themselves or with anybody else that has the clarity to drive them forward and put them on a pace that allows them to say, hey, I've got something that's going to work even amidst all the uncertainty and the volatility in the marketplace and geopolitical and in the election cycle that we have today. So again, this is just a question for you to ask yourself, but today, how much autonomy do you feel like you possess over how you spend your time? One lower in the scale, like you got no freedom at all. You are scheduled out. I mean, someone always has an agenda on your time. You look up and someone's going to grab you. You've got some kind of a responsibility or obligation. Versus 10, your complete freedom. No one has an agenda on your time. You pretty much call the shots. Now, if I said I had 10, my wife would knock on the door and have a honeydew for me to do. So I can't say I have 10. Okay, but I'm pretty high on the scale. And people say, well, why do you work? And I tell people, no, you don't understand. I don't work. I really don't work. I love what I do. I love the team around me. I love the people I get to help. So when people say, you're always working, no, I'm not. If I wasn't doing something purposeful in my life right now, I would be a lost soul. I would be a lost soul. I'd have to find something to do because, and I think you're the same way. You're going to find you're the same way, even though right now you probably wish you could take your foot off the pedal. Some of you, you're still going to want something to do. So finding that purpose in life is important to find it before you take your foot off the pedal. It becomes a self-sabotaging situation I see for many people. All right. So here's the big one. How much is enough? How much is enough? And you have to reverse engineer. The question that nobody seems to answer, or when they ask themselves that, or no one can answer for them, is how much do you really need? Well, yeah, David, that number is going to change. Of course it's going to change. We already talked about inflation. But if you just had to peg it today, how much is enough? What are you striving for? And how do you make your money and your assets work for you so you can fill that how much is enough question? In Freedom Founders, we use what we call the freedom number. That's your lifestyle burn rate. Like today, what does it take to fund your lifestyle, your family, your obligations? They may change in the future. They may go up in the future. They may go down in the future. But what is it today? It's learning how to measure this and then build the asset base, the investment base that can start producing this number. And then you close the gap. You close the gap. And as soon as the gap is closed, basically, you've got that freedom of time. Now, it doesn't mean you have to quit adding to it, adding to your net worth, or quit your business or your practice, but it means you can have the freedom of choosing, the choice, the options. That's what you want. And there's no reason to peg this freedom of time to some arbitrary retirement date of whatever you choose or whatever your financial advisor tells you. Forget that. See, that's just old school, bad thinking. It's indoctrination, and it doesn't make any sense at all. You've got to reverse engineer. So how much do you need to achieve, say, for example, $150,000 annual income before tax? So if you plug it in at 1% return, well, the math's easy. You need $50 million. You need a lot if your return's only 1%. Double return, you need half the capital, 7.5 million. 4%, you need, quarter of the capital, 3.75. If you get 8% return on your investments, you only need 1.875 million to produce that. And if you can get 10% return, which, ladies and gentlemen, it's not hard to do if you have the right guide path and the access to the right investments, you need $1.5 million of capital to produce that. See, the problem with most financial plans is when you retire, they tell you, well, we've got to put you in safety now. We need to put you in more in bonds and fixed income. Well, up until recently, that didn't produce much. Today, it produces, decent because the federal interest rate went up. But still, 4 or 5%, as you can see here, means you still need a lot more capital than if you could produce a higher rate of return without congruent risk. Because most people say, well, if you're trying to get too high a return, the risk goes up. Yes and no. Yes, if you have no idea what you're doing, you're gambling. No, if you are investing in what you understand in the right format. That's the key difference. That is the key difference. So which is more important to you? Net worth, build it up, build it up, build it up, or the cash flow? Well, you need both. You need both, no question about it. But I believe there's too much focus on the net worth without a corresponding focus on the cash flow that net worth can produce. Back to that previous slide. You can have a lot of net worth, but if you don't know how to make money, then you need a lot more of it. And it means your freedom point is going to be pushed out a lot further than it needs to be. I'm just telling you, I'm a living example of that. I wasn't able to pull away from my practice in my 40s because I had $10 million or $5 million in the bank. Not at all. I had assets that I learned that would produce income for me, whether I worked or not. And that's the key. So accumulation versus replacement income. That's the difference. My model is replacement income with, yes, assets, with some accumulation, yes, but in the right assets. Accumulation is the traditional financial model, the Wall Street model, the 401k model, which is like the uncertainty of how much is enough. Well, it's never enough. You just got to keep building it. Versus the specificity of an actual freedom number that you need, something producing a certain amount of cash flow. Depletion principle. You're taking it down, taking it down, taking it down. In my model, you're not depleting it. You're sustaining it, and actually it's growing because you need to have that growth, particularly if you want to leave a legacy for other people, leave money to charities. I'm not a take it down to hopefully when my money and my assets run out at age 92, that it all meets right in the middle. I don't want to live like that at all. That's not my goal. My grandfather lived to age 98, so I'm not personally planning on checking out, at 88 or 92. I could, but then I also have other people that depend on me, and I'd like to leave something for them. So I'm not about this depletion model at all. I just never believed in it. The accumulation model, being in the financial market, my opinion, has much more vulnerability to the market volatility versus the alternative space certainly does have vulnerability to some extent, but the inefficiency of the market allows for a lot less volatility, even though we have the market cycles, a lot less. There's always the risk of chasing yield, and that's where we are right now in this market cycle, where we're in denial. People are still chasing, I can get more and more and more and more. I think it's very, very, very dangerous, very dangerous. Versus managing the risk and just taking what the market gives you. Being conservative and understanding there's times to be aggressive and times to pull back and be ready to be aggressive again at the right time. So the disadvantages of tax deferral plans, that's your 401k plan. Typically, that's what I see most people doing. And it's not terrible if you have one at all, because you can still self-direct it into alternative assets. So keep that in mind. Most people do have one. I even had one for a while back in the 90s. I killed it because I could do much better outside of it. So here's the disadvantages. Higher future taxation. In a conventional, traditional IRA, not Roth, but traditional, you're going to pay taxes, as you probably know, on the distribution side. Well, where will the tax brackets be when you're taking that out? They're not going to be lower. It's a lockbox. Your money's tied up till 59 and a half, and you can't do anything else with it. So if there's other opportunities in business or otherwise, you've just tied it up and you can't take it out unless you pay the tax and the penalty on it. It gives a false sense of security. Hey, everybody does it. I just load up the 401k, take the tax deduction and defer the taxes and compound. That's the magic bullet. What if we have another period of stagflation like we had in the 60s in the 70s? What's that going to do for you? If that's all you know and it doesn't work, where are you going to be? As I said, higher tax brackets. You're converting the opportunity to have long-term capital gains profits, which you get in tangible assets like real estate, your business, into ordinary income. Your retirement account, everything comes out as ordinary income, taxes ordinary income. You see, you lose all that if you're putting everything into that bucket of qualified retirement accounts in a traditional mode. You also lose the stepped up basis allowance, which would be passing on the assets to your heirs. With assets outside your retirement account, when you die, you may know you get a stepped up basis. So when you die, your heirs get that asset at whatever the current market value is, meaning they could sell it the next day and pay zero tax. If you sold it before you died, you would pay tax at whatever the long-term capital gains tax is, and they're prognosticating that's going to go up from the 20% that it is today. They've even pushed it as high as, hey, we're going to take it to 45%. I doubt if they take that one plunge, but you see where things are going. You're losing a lot by doing the tax deferral method, which I know everybody tells you to do, but I'm just saying too much there, and I think you're making a big mistake. You also lose the opportunity that we have in tangible assets, depreciation, cost segregation, as I said earlier, long-term capital gain tax treatment, and you can't exchange. I can exchange profits in tangible assets like real estate. I can exchange my equity, my profits into other ones, move it to other opportunities, and pay no tax. So you lose all of those opportunities in qualified plans. I'm just not a fan. But again, you've got to be willing to do some of the work to manage your capital. It does take work, but there's faster ways to do it than trying to do it yourself. And that's really kind of what we do today with Freedom Powders. So more ROI, more return on investment is not the answer. Here's my quick, down and dirty economic storm preparation checklist. I'm going to go fast. Burn rate. You've got to understand what your burn rate is, your lifestyle burn rate, create margin, understand what assets are versus expenses. Reducing or eliminating debt wherever you can, particularly short-term or floating rate, variable rate debt. Remove that as quickly as you can. Dry powder, liquidity. We talked about that. Where's your insurance? Where's your liquidity in your asset allocation? You've got to have some of that, and it's also preparing you to take advantage of the opportunities that are coming as we go through this market reset. Real tangible hard assets. As I said, I'm a fan. Timeless value, inflation hedge, cash flow. It's all there. You just got to be plugged in to know where and how to do it. But man, it's a game changer. Your business, having the resiliency to manage through recession, maintain your profit margins, revenue streams. Be wary of expanding too fast or taking on, again, credit lines that can be pulled back at the snap of a finger. When the banks need to pull capital in, they're going to go after their best borrowers because they need the capital when they get audited and the feds say, hey, you got to cover up for these bad loans. Go after your best borrowers and pull the capital in. Not a good day. Business equity. You want to, again, maintain the value of your business, for the day that you decide to sell it, and plan your exit strategy. Beware of the promises of back-end future recaps and deferred payments. There's been a lot of that, obviously, in the last 6 years. Those days have dwindled down quite a bit, so just be wary of that. Have a personal family emergency plan. Where are the resources? Where are the passwords? Where's everything kept? You've got to have that put together because you never know. I just had a good friend, very good friend, known well in the dental arena, passed away on Monday, and he was in the best of health, and gone like that. Got a call from his now widow the next morning, and she fortunately had a lot of things put in place, but still she's dealing with obviously the emotional devastation that this was like. They were actually Freedom Founders members for a good time, and I'm thankful they were because they've got things in place. So she's not, at a total loss. Many people unfortunately are. Relational resiliency. This is, in my opinion, your best insurance policy. Who do you know? Who are your 5? If you don't have that 5 people that can give you good advice or be there when you need them, you're missing out on the best insurance policy. You've got to be intentional about building that list. All right, here's one resource I'm going to give you, right? Now you have to ask for it, okay? But we'll ship it to you complimentary, okay? There's no asking for credit cards. Go to financialarcbook.com. My latest book that we just published called Building Your Financial Arc, How to Survive and Thrive During the Next Economic Storm. I put a lot of the principles that I've gone fast over tonight into this book. I think you'll really enjoy it if you take time to study it. So go to financialarcbook.com. There's no obligations there at all. Just go and fill out the information there. We'll ship it to you. All right, I've got one more poll question for you, Alex, if you want to put this up. I want to know what your concerns are about real estate as an investment. I know you've got concerns. You should have concerns. So let's put them up. Here's the questions. You don't understand how it works. Could be valid. You don't have enough time. to do it. You don't have the access. Like, where do you go to do this? You don't want to be a do-it-yourselfer, so where are you going to go to make this happen, right? And then, hey, real estate's probably also about to take a big hit, or someone's taking a big hit right now, so that sounds kind of scary. Pick one of those. What's the greatest concern you'd have about investing in real estate if you were to do it today, or maybe you are doing it? What are your concerns today? Because there's always concerns. Nothing's a free lunch. So we'll give you a few seconds to look that over. I'd just be curious to see what your thoughts are about real estate investing in general.
All right, we'll give it just another moment here. If anybody else wants to jump in on the poll. Okay, very good. Good, we'll end it in 3, 2, 1. Oh, we had 2 more last minute additions.
Okay, good.
All right, here we go.
Yeah, get those ballots in, right? Don't be, you got to vote. Okay, good. Don't have access. Okay, well, that's interesting. Over 60%, which I think is a very valid question to have. Some don't have time. Not sure how it works. A few people, and it's about to take a big hit, or we're all pretty even. So, all right. Well, thanks for giving that feedback, because that was really helpful to me to know where people are coming from. Excellent. All right, we can finish that slide off. All right. The main problem that we in Freedom Founders help practice professionals solve is buying back time. That's the whole key. That's what you really want in life, is how do you buy back time? And to do that, you've got to be able to feel pretty confident or certain that you're able to replace your active income. Not all at once. You build towards that milestone. But I've got younger people that have gone through Freedom Founders that have gotten there in their 40s, like I did. But they didn't start like I did when they were in their 20s. They started, like 2 or 3 or 4 years in Freedom Founders and got there to this point relatively soon. Now, that's not for everybody. It depends on where you're starting with. It depends on your lifestyle burn rate. Depends on other variables. But if you're reasonable and you attack this as a couple, it's a game changer. I'm just telling you, it's a game changer. I know you probably feel like the same way, that real estate's one of the best ways to create passive income outside of your own business, but that's active, right? If you want passive income, then I still like the tangible aspect of real estate, because it provides so many benefits, and you can be much more passive in doing it than you are active in your own business. Most high net worth investors believe and have real estate somewhere in their portfolio. It may not be their main thing, but everybody that's wealthy has some real estate somewhere, because they know historically how well it's performed. So how do you do it? The problem is, as some of you alluded to, some of you may be too busy, certainly developing the skills, or the bigger one tonight was, where to start. Where are the access points? Where do you go? Because let's face it, in the last decade and a half, when money's been figuratively running uphill, because there's been so much money chasing yield everywhere, stock market, real estate, there's a lot of people that are very willing to take your money and promise you big returns, right? So you have to be very careful. The diligence, the underwriting, the understanding is critical. When we're in the beginning part of a market where things are starting to come out of a recession, just about anybody who's doing anything halfway competent can make money. But when we get through a market turn cycle like right now, this is where, as Warren Buffett would say, we find out who's been swimming naked when that tide goes out. Unfortunately, many people who think real estate's sexy decide to do it themselves, and they find out that they try the family and friends method or do it themselves and find themselves as what I call accidental landlords. A lot of people took on short-term rentals during COVID, because people were looking for people couldn't travel, and it was a big thing, but it was a fad, it was a trend, and many people bought into it, and now they're finding that fad is kind of waned, and they bought too high, and their leverage position is too big, and a lot of sell-offs going right now. So again, understanding and not getting caught in trends is very, very, very important. Freedom Founders is like a shortcut. We fold time, we collapse time for those who want to learn how to do this, help them curate through the education and the access points that we have. It's leveraging a community. If you've ever been a part of a community, probably nothing like we've done in Freedom Founders, but it's very transparent. It's very, very collaborative is the word I would use in terms of what we do. So the key to financial advocacy, education. That's where you become more self-reliant. And through education, you will have a different mindset, and therefore your behaviors will change, your outcome will change as a result. It just happens when you learn something different and start thinking in a different way. You need an introduction. You need a network connection. Again, that's a big piece of what a lot of you said tonight you're missing. Where do you start? How do you get started with any kind of confidence? Because you don't want to get caught in something and take a loss because you got in at the wrong time or the wrong thing because it worked in the past. And that's a big problem today because the market is correcting. We are going through a major shift, and doing it with somebody who's been through multiple shifts in the market, I think can be a big advantage. Implementation. So there's do it yourself, which is what I started doing when I was very young and did that for about 15 years. And I started moving more towards doing it through or with other people. Some people want a done for you plan. I don't do done for you. I don't believe in done for you. I think done for you, in most cases, leaves people hollow and doesn't teach them anything. So I think done with you, with the right people, is absolutely the way to go. With A, which is do it yourself, in terms of proximity, you're closest to your investment. And that may be an advantage, certainly, because you want that control. So if I'm buying my own properties in A, I'm very close to that. I have responsibilities. It's going to take me time, but I'm very close to, and I can make all the decisions. If I'm doing a done with you, then I've got a little bit more distance from my investments, but I'm having a chance to build relationships and get the education and the underwriting due diligence to still feel like I have got a level of control that feels good to me. C would be done for you. That would be the abdication of, hey, here money manager, here 401k manager, here it is, take it, run with it, and you're way out in the spectrum. You have no proximity, in my opinion, to your investments at all. So sorry, I should have put this up here earlier. A was do it yourself. B is done with you. C, out there on the curve, is done for you. So why does Freedom Founders work so well? In the right hands. It's not for everybody. Not for everybody. If you want to go solo versus done for you versus done with you, and again, done with you is what I've enjoyed in my life and what I think works best in Freedom Founders. Going solo, perfect for people that are young, got the energy and the time, no problem. This is just pictures of our meetings, but you can tell we're all about collaboration, both live meetings, and we also do a lot of interaction on Zoom and trainings there. So travel isn't imperative all the time, but we do like the live meetings as well. It's a big part of how we roll. Dr. Cody Cowan was one of the people I was referencing earlier that got free in his early 40s. He says, with Freedom Founders, I don't have to produce and be the one in the chair from 7 in the morning till 5 in the afternoon. He's partnership in several practices, but he loves life because he's got that base, he's got that safety net, he's got his lifestyle burn rate covered with his assets, and now the practice of dentistry, he just gets to do it on his own terms. And I don't think he's in a hurry to quit at all, because he's got to be like all of us. He's got to be doing something to be purposeful, but he gets to do it the way he wants to do it. And I think that's the whole key in life. You've got to clarify a plan and a strategy. This is what we do at our blueprint meetings, very, very small groups, where we actually individualize the actual game plan for each of our couples. Get a clear investing plan, personalized to the goals and timelines of each couple. Getting crystal clear on how much is enough. That's the big question. We can help people get specific on that, reverse engineer, everything changes from that point on. Evaluating what investments are working and where there are opportunities for better, more efficient returns. Being able to compare and contrast a potpourri of different alternative investments in one place is a real advantage versus saying, well, I want to get involved in real estate. I've heard that multifamily syndications have done really well. Let me go out and see what I can find. Well, again, you're going to find a potpourri out there, all kinds of people who would take your money. How do you know? How do you know? You don't. You haven't had a chance to compare and contrast anything. Taking action, making progress towards your goals. We like to analyze. We like education. It's important. But sometimes we need the confidence that a group or community provides for us that have already gone down this path and saying, hey, if they've done it and they're real people like me, maybe there's something here. I think there's confidence that breeds from that type of association. So our blueprint days are where we develop a clarity in a plan. Just again, some pictures of the small group. It's very interactive, and we really open the door to really get clarity. Couples love it because they communicate on a basis in the financial realm that they probably really haven't ever done up until that point. And that's what gives them confidence to go forward. Bob and Gertrude, great people. They came to us 2021 and were so burned out of their practice. And again, their financial advisor said, I don't know, you should keep practicing. And they were just, I mean, the tears of just the stress that they have been going through managing their practice all of the years they did. We gave them a plan. And literally by the end of that year, 2021, the practice was for sale on the market, and they sold it by early the next year. And they're still with us today and loving life, loving being with their family. They got to move out of California to a lower tax state, and the freedom they have today, they're just enjoying the heck out of it. And they beam. This is the smiles they have today. They didn't have those smiles when they came to us, three years ago. So real briefly, who's Freedom Founders for? What's a good fit? Coachable attitude, well-managed debt. You don't have to be debt-free, but just well-managed. Desire to be a passive investor, not active. If you want to be active, we're not for you. Nothing wrong with being active, but we would not be a good fit. You've got to understand the value of real estate, but you're not sure how to get started, which is what a lot of you said tonight. Not a fit if you're still growing and acquiring a practice. Look, you got to focus on your engine, plan A, and if that still has optimization, really focus there first and do your investing in alternatives later. Again, if you want to be active or a do-it-yourself investor, it's not what we do. I don't teach that here. I did it myself. I know how to do it, but not what I teach in Freedom Founders. If you're looking for outsized gains, if you looking for what I call speculative high returns, I'm conservative. Yeah, 10% is really easy for us to get. We can get higher when the market provides that for us, but right now I'm risk averse like most people. There's great places in real estate to invest in what we call a capital stack, which I don't have time to go over tonight, but we can be more in private credit versus equities. Again, I've got a resource I'll give you that will give you some training on that, because again, I don't want to take your time tonight, but I'll give you a resource that you can access to get that information. If you're still growing your capital base, in other words, if you're young and you're starting to invest and build some capital base, good for you. I'll give you some numbers that I think are applicable for Freedom Founders. But don't worry, I'll teach and give a lot of content over the years that you can still follow along if it's not right for you. But if you're in a position where you'd like us to help you create passive income and build a real estate portfolio so you can stop relying on your practice completely and start seeing your ability to see assets produce the income you need, then easy to schedule a call with my team. And a call is not going to be a sales call. It's a discovery call. Literally, you're going to have the chance to get some clarity about where you are and what you're doing. And you may receive an invitation, to check us out and take a next step, which would be coming as a guest, be a guest participant, but there's never any obligation. So if you'd like just to get some clarity, I'd encourage any one of you to take a step and schedule a call. It's there for the giving. And Alex, who's helping me tonight, takes most of those calls. He's been with me for now 8 years. He understands exactly what we do and how to give some discernment to the questions and where you are. What I will say is the longer you put off building your portfolio, the harder it's going to be to confidently gain the freedom that you want from your practice. I see it all the time. People put it off, thinking some magic's going to happen, and that magic never happens because they never had a plan. Theodore Roosevelt said, in any moment of decision, the best thing you can do is the right thing. Next best thing is the wrong thing. And the worst thing to do is nothing. So in Freedom Founders, if we believe there's a fit, we'll give you a chance to step in. And if we decide later it's the wrong thing because the timing's not right, then there's no obligation. So we'll make sure it's not the wrong thing. But if you do nothing, you have no chance to find out whether you're doing the right thing or the wrong thing. You've got to take some step forward and still have that safety net to know, okay, if it's not the right timing, I can turn back and no harm, no foul. If you're a practice professional with close to $1 million or more in investable capital. Now, investable capital does not mean cash in the bank. Doesn't mean you've got it liquid. It doesn't mean that you have to have that much in your retirement accounts. It can be an entire portfolio of capital that could be deployed, not that you have to deploy it, because I don't care how much you deploy. I don't sell real estate. Freedom Founders does not sell real estate. I don't manage your money. We connect or educate. But I want for the ROI on the financial side, if you've got something close to $1 million that over time you could invest or would want to invest, then that's going to make it workable for you, along with the other attributes that I mentioned earlier. This may be your time to take a step forward. Again, there's no obligation. If you're just teetering on the edge of, I don't know, should I do this? I'd say just take the risk of taking a step forward and having a call with Alex. The question I would say back to you again, because 32 days from now, the question is, who's going to save the day? For us personally, neither are going to save the day. For us personally, all right? We'll choose which one we think will hopefully not destroy the country faster than the other. That's all I'm going to say about politics. It's up to us. We've got to take the responsibility and learn how to manage through all the uncertainty and the volatility. It's not going to get easier. It's doable, but you can't do it with old models or abdication like so many people have done in the past. I promise you that's not going to work. So just book a time, speak with my team right there, freedomfounders.com/discover. Easy to do. Again, no obligation. Take the opportunity to do it. And I'll give you one more training resource. If you book your call by tomorrow night, just book the call. You don't have to have the call. You can put the call next week or 10 days from now, whatever you want to do it. But just book the call. I'm trying to help you take action, okay? That's all I'm trying to help you do here. I'll give you a training resource which talks about where I'm putting money today in real estate. The risk curve will show you equities and private credit and build out what I call the risk curve and show you how we are offsetting and hedging risk, but also preparing ourselves for what's coming. So it's a great resource. Again, all you have to do is book your call, nothing more than that, and Alex will send it to you so you have that resource. So I think that's what this is part of what the training will look like. The blanks will be filled in with the training, but it will show you returns and risk and where on this allocation curve you can position yourself based on where we believe we are in the marketplace today. And that's, again, something we talk a lot about in Freedom Founders. Okay, so that's really it. There's the link to schedule a call with Alex. Alex, man, 8:01. You didn't think I could do it, did you? But I did it.
Right on the dot,
There you
David.
go. There you go. I wasn't watching the clock. I just knew it was coming up. So, what else could we help our people with? Any questions I could answer for anybody tonight? Because I'm happy to stay on. Those need to go. Certainly glad you were here tonight. And if I can help you any time in the future, stay connected to us. But any questions, Alex, that anybody has for me?
Yes, we have just a couple of questions, and folks, you can put your questions in the chat as well. But here's a question. You've discussed the stock market cycles, but how do you protect against the ups and downs of the real estate market? Real estate took a big hit in 2008. Is real estate due for another reset?
Well, certain aspects of real estate took a hit. Certain aspects. Now, I will tell you where I was in 2008. I still had a pretty sizable single-family rental portfolio in North Texas. That's what I built over the years. I had some note receivables too, which is what I call private credit, which is note receivables secured by real estate. So I really had a portfolio was somewhat balanced between the two. Being in the affordable housing sector, which really is what I was over 3 decades, I went through a number of cycles. I will tell you this, my real estate, yes, my equities, even in Texas in 2008, may have gone down in value 15%. But guess what? I didn't care. And my real estate didn't care because I was not a net seller. I didn't have to sell. There's always somebody that wanted to live in the house, in good houses. Now, I don't do that today, okay? So where I was then wouldn't apply to me today. So where am I today? Because the same thing is sitting right in front of us. Commercial real estate is taking hits. Office has been big hit, but multifamily has also been taking a hit. Well, I'm not going to say we knew exactly when we'd start seeing a change in the market. I was predicting a correction, what, Alex, back in 2019. Okay. So I was a little early before my time, but we as a general, not a rule, but as a kind of a consensus, again, I don't tell people what to do, move more to the private credit side where we can loan money either to individual borrowers, which I've done a lot of commercial borrowers through the network, or we've got fund managers and syndicators who also will lend money, private credit, to secured by collateral that we like because it's more recession resistant, like self-storage or certain other asset classes where the leverage is not to the moon. So we can be private credit lenders and have more liquidity and be safer on that curve. So yes, you're right. Real estate is as vulnerable, not as quickly as the stock market, because the stock market is more built on psychological sentiment. So it can go up fast, it can go down fast. Real estate will also respond to the changes in the cycle, but much more slowly. So you can get ahead of it on both sides of being defensive, but also on the offensive side. That's why I like it, because it doesn't move so fast. With the marketplace, we have to put stop losses on it and worry that it's going to tank, like it does with major corrections. So you can position yourself in the capital stack, equities versus private credit, which again, I didn't have time to go into. I will give that a little bit to you on the risk curve trading, how I look at that. But that's how you do it. So yeah, real estate is susceptible, but I see a lot more opportunity to be more in tune with what the market's doing and more protective there and not take the big losses that many times you get in the stock market just because that's the way it rolls.
Here's one more question, and then we can probably wrap it up for tonight, David. what are your thoughts on buying local rental properties in today's market? Is that still a viable model?
I would say would be not my preferred place to go. And as I said earlier, I was a big fan, or I have been a big fan. I'm always a fan of good residential real estate. I'm always a fan of it. Okay. And if you already have some in your portfolio, maybe you bought it, 4 years ago when before prices started going up, interest rates started going up. And if you've got it in your portfolio, and you like it, hang on to it. Okay. No problem. Because it is very resistant to people leaving and saying, I don't need a house or I don't need shelter. Good place, good house. But today I would not buy it. Why? Because the valuations in housing are still too high. I think we still have yet to see some of the air be taken out. Some markets have seen the air come out. I mean, some of the ones that went way up, Austin, Boise, Vegas, Phoenix, other Western states, Washington, Oregon, Denver, Salt Lake City. They've taken some drops. I think it's got to come down more. You've got to really look and say, what is my real marginal cash flow beyond my ordinary operating expenses? And are you going to use debt leverage? Normally, when we buy rental properties, the big opportunity is to use debt leverage. Well, where are interest rates still? Oh, they've come down a little bit, but see, the prices are too high. And if you're going to use debt leverage, which is usually the advantage, now you've got interest rates high and you've got prices high. Those two, in most markets, you're not going to cash flow. And cash flow is what you've got to have with tenant-based cash flowing real estate, whether it's single family, multifamily, self-storage, any asset class like that, you've got to have the cash flow. So I think today it doesn't make sense. Now, that could change. Give it 12 months, go through the election, see what happens. If we see some resets, if interest rates do come down, which I'm not saying they won't, they could come down for a short time and prices come down, there could be a time to lock back into some of that. And that's what I did in 2009, 10, 11, 12, 13. I bought a lot of real estate because it was easy to buy. And so I already had my portfolio that was running well, and I bought, we call buy the dip, bought the dip and rode that back up. So right now, even though I have the ability to buy that stuff where I am in Texas, I'm not going to do it. Still priced too high. I'm going to wait. There could be that opportunity coming though. So patience, I think, is critical right now. Don't use recency bias just because you've got friends that made a lot of money, and a lot of people did make a lot of money in the last few years with the rapid rise of valuations because of why? All the stimulus money and the cheap interest rates. Now we're on the other side of that, and we're going to see some correction. So I'd bide my time with that. But again, I'm always a fan, long-term fan of good, solid, affordable rental property.
Well, thank you for sharing tonight, David. You always just share from your heart and share, I think from many years of experience and insight, not just in your own life, but also now working with hundreds of other docs over the last almost 15 years here at Freedom Founders. And also, I just wanted to thank all of y'all for being here tonight. I think it says something about you that you're willing to take an evening and learn, invest in yourself, and think about the future strategically for yourself and your family. We're certainly entering a season of change and volatility, and that comes with risks, but it also comes with opportunities for those who are willing to position accordingly. So, for those of you, if these topics are of interest, David has a weekly blog, a weekly podcast, a newsletter. You can find all of those at freedomfounders.com and do a deeper dive. And for those who'd be interested, I'd be happy to chat with you. Just schedule a call via the link there, freedomfounders.com/discover, and be happy to help explore what this might look like for you and find some clarity together. So I think that's it for tonight. David, back to you.
All right, very good. Thank you all again. Have a great evening, and hope to hear from you sometime soon, or see you somewhere on another webinar. Maybe come to a Freedom Founders event if you can do so. All right, have a great evening. Take care, everybody.
Good night.